Hey everyone, welcome to another segment of Dear Business Owner, where today I'll be talking about multi-member LLCs and partnerships. And really, because a lot of people don't really understand the fact that when it's not just you alone going into business, there's a lot more impact to consider because, again, it's not just you, there's other persons to be considered in the situation, right? So, one question that I want you to, kind of keep in mind really is what happens now if you go into business with someone else, not just you. What does that look like, right? So for us today, I'll be talking about that from a tax and accounting perspective so they can grasp that understanding as much as possible. All right, so with that being said, my name is Rose Brown, also known as the accountant therapist, and I am the CEO of Brownsville Fleming Consulting and Accounting Firm, where we provide an array of accounting services. Right. And Dear Business Owner truly is for all my entrepreneurs and business owners, whether you are far ahead in your entrepreneurship or business owner journey, or you're thinking about starting, right? It can be a little bit intimidating. So, what I do during these segments is provide information broken down in a manner that business owners can understand from a tax and accounting perspective. Okay. So, with that being said, let's jump right into everything. So, this week is really a buildup of last week, right? Because last week I talked about single member LLCs and sole proprietorships. Now, this week we're talking about multi member LLCs and partnerships. It's important to note there are different types of partnerships. You have general partnerships, limited partnerships, and the list goes on. But ultimately, well, generally from a tax perspective, partnerships on a whole are treated the same, right? And it's all going to go down to the level of what I'm talking about today. Now, the way in which the partners themselves are treated may look a little bit different depending on how much of a liability they're willing to take on within the partnership, how limited it is, right? So just to recap, a business entity is any company where one or more individuals come together to begin conducting business, whether that's a trade, service, whatever it is that you offer, but you guys come together in an effort to offer something to the public for profit, right? Okay. And sometimes it can be nonprofit, depending on the nature of the activity. Okay. So ultimately, it's important to note that during these segments, one size does not fit all. Every entity needs to be chosen based on your individual situations. So a couple weeks ago, I started talking about business entities, but I've broken it down in different segments. This way you can hear the different types. And again, this is informational. It does not take the place of, say you came to us individually to talk about this, or going to your own attorney or your own accountant to really talk through which entity may be best for you. So take that into consideration that one size does not fit all. This is more so informational. Okay. So with that being said, let's first start talking about really the differences, right? Because from a tax perspective, the multi-member LLC and the partnership are pretty much looking similar, right? So as it pertains to the differences, if it's just a general partnership, it's literally two people saying, hey, we're going to go ahead and start a business together. We're not doing anything formal. We're going to go ahead and take on all the liabilities ourselves. We have no liability protection. But in that situation, though, the one organizational document that you would definitely want to make sure that you get is an EIN, right? Because as you start a partnership, you can't individually operate under your social security number. So you pretty much have to let the IRS know, hey, we're a sole prop, it's just us two, right? And they issue that EIN and they let you know when your tax return is due. Whereas for a multi-member LLC, you have that liability protection, right? The only thing about this versus a single member LLC is the fact that you now have two or more persons, right? And in both of these circumstances, you can have really an unlimited amount of members or partners. There's no limit on this part, okay? And even with that, from a general partnership perspective versus a limited partnership, the liability looks different as well. So that's another thing you want to keep into consideration. Now, within a multi-member LLC, The persons who own the company are referred to as members. Whereas in a partnership, the persons who own that company is referred to as partners. May not be much of a big difference for a lot of folks, but that's how you appropriately refer to each person that owns the actual entity. Okay. Now, of course, the setup looks a little bit different. Where for the multi-member LLC, you want to go ahead and get your EIN, right? Your LLC needs to be set up, and you want to get your other organizational documents. Whereas for the general partnership, it's not a lot more that goes into it unless you're taking the step of becoming a limited partnership, right? So that's another part that you want to take into consideration. Now, as we dive into the similarities, these are both referred to as flow-through entities. So regardless of the type of partnership, it is still a flow-through entity. Flow-through entities mean the business itself does not pay its own taxes. It is the members or the partners who own that entity that would be responsible for paying those income taxes, right? And see right there, I'm emphasizing on income tax because that's what the individuals would be responsible for. Okay. And what I'll do in a couple of minutes as well, I'll be showing you an illustration so that you see the impact. Okay. Excuse me. Now, with that being said, of course, the business itself is not responsible for its own taxes, right? So that includes the federal income taxes and the state taxes because it flows through. Depending on where you are, the local taxes may be a direct write-off if it flows, if the state requires the business itself to file a tax return. Okay, so you want to make sure that you're on the lookout for that. So if we give an example, Philadelphia, persons who operate in Philadelphia needs to have a business income receipt, tax type, and a net profit tax attached to their city tax account, right? So, and those are just the two common ones. With those two items there, the city may require you to file depending on the entity of the business, or if it's just you, then it's just you paying those taxes, right? Not the business itself. Okay. So as it pertains to the tax impact, right? So it's definitely time to share that screen. Here we are. So last week we looked at something similar to this, but this week what we'll be doing is building up on that, right? So we already know that a sole proprietor and a single member LLC for tax purposes are treated the same. So they pay themselves by taking draws. Their business activities are reported on a Schedule C, which is a part of the Form 1040. And yes, they are subjected to self-employment taxes. And just the breakdown of what self-employment taxes are, that's a makeup of your Social Security and Medicare taxes, which both the business and yourself has to pay. Okay, so if we take a step further, we have our ownership type here. So as I mentioned, from a tax perspective, a multi-member LLC and a partnership are pretty much treated the same, right? But as it pertains to how they pay themselves, look a little bit different from our guys up here. Okay, so if you are a multi-member LLC or a partnership, you pay yourself in two ways, depending on how involved you are within the company. So if you are providing services, like actually you're providing services as a member or a partnership, you're oftentimes compensated via guaranteed payments. Now, guaranteed payments has a different tax impact than distributions. And distributions, you can get that in conjunction with the guaranteed payments. This can be given at the leisure of the partners or the member, whatever they prefer to do. Right. And I'll also touch on how distribution impact these particular entity later on as well. Now, once these are taken, we're at year end, what happens is the business itself needs to file its own tax return, right? So that tax form is Form 1065. So usually if it's just you under these entity, you report it as part of your personal, right, on a Schedule C with your 1040. But in this particular situation, it has to be filed on its own tax form. And then what happens is it spits out what is called a K1. Each person that owns an interest within the company receives a K1. That K1 needs to be reported on your personal tax return. That's how you pay taxes based on the business activities. Therefore, you cannot file your personal tax return before you file the business tax return. And that most likely is the case why they made the Form 1065 due on March 15th. So usually when it's just you, you file everything together, right? And it's due on April 15th. But when you proceed to have a partnership or a multi-member LLC, and you have to file your taxes on a Form 1065, that document, that tax return is due on March 15th. I can't tell you how many folks don't know that. And because of that, they've paid thousands in penalties because the IRS assessed a hefty penalty for late filing, right? So you want to make sure this is something that you avoid. And of course, that penalty that is assessed to you is not a write-off for the business, right? So you have to make sure you're not just giving your money to the government just like that, right? So if you can prevent situations like that, just making a note, write it on your calendar. Again, this is if it's two or more persons within the same entity. Now, under these circumstances, it's the same thing here. Yes, there is self-employment taxes assessed. And this is really because as a sole prop, a single member LLC or a multi-member LLC or a partnership, none of the members, owners, or partners are considered employees. So because you're not an employee and you're earning income some way, somehow, you have to pay your portion of self-employment taxes. And that's why they assess that 15.3% based on usually the net profit if you're sitting in this category here. And then if you're sitting here, it's based on the interest, your percentage ownership that's distributed to you. So let's say it's two persons, right? 50-50. And the company had a net profit of 100,000. Each of you would report $50,000 on your personal income taxes. And that's how much you would be paying. Well, that's the amount that you would be paying self-employment taxes based on. So you definitely want to make sure that you really take this into consideration, whether you're in business for yourself or with another person. Actually, I'm gonna put a extra stress on this one. If you are in business with another person, listen, it's no walk in the park. I've seen businesses fall apart because of the accounting aspect, people being paid incorrectly. So a person may say, hey, I should be getting guaranteed payments or I should be getting distribution. See, not understanding these components drives a wedge between the partners or the members. So you have to make sure that you understand how this is happening. This way, all partners or members are on the same page, right? This becomes very critical. All right. So let's make sure we touched on everything here. And even under these circumstances, there are no double taxation. And again, just to put a reiteration on that, double taxation only occurs with C corporations. Okay. All right. Now, as it pertains to, we talked about paying yourself. When it's time to pay taxes, right? What is recommended in a situation like this is for you to do a quarterly assessment of what that net profit is, right? So at the end of each quarter, what would your share look like, right? What would your share of the ordinary, the net profit look like for that quarter? This way you're not backed up with taxes, and at year end, you don't have a big lump sum of taxes to pay. So you want to do a quarterly assessment to make sure that you're on top of it. Either you're setting the funds aside or really making those estimated tax payments to the IRS. Okay. Earlier, I mentioned distributions here. Another component of being a multi-member LLC or a partnership, which really complicates things because it's not just you, it's more than two persons or two persons at a time, is what's referred to as your tax basis. Now, your tax basis pretty much tracks what if you decide to sell the company at some point, what would your gain look like? So when it comes down to tracking your basis within the company, and this is an ongoing conversation I have with all my clients to make sure that, hey, we're tracking our basis because that's truly important. Your basis lets you know how much loss you can claim in a given year. Your basis lets you know whether or not you'll be claiming a capital gain in that year. Or when you go to sell, your basis will let you know what your gain on the sale of your ownership interest within that company is. So things that really contribute to that basis aspect is, hey, what was your initial capital contribution into the company? Year over year, are you contributing more owner's investment, right? Are you taking out distributions, right? Distributions decrease your tax basis, whereas contributions increase your tax basis. Did you have a profit in the business that increases your basis? If you had a loss, it decreased your basis. Now, of course, there's a couple other things that could increase or decrease your basis, but that is a critical component to track. It's an issue that a lot of people face when they go to either depart from the company or sell the business, whatever it may be. It's important to track the basis. Okay. All right. So overall, as it pertains to a multi-member LLC versus a partnership, the real separation between those two is the fact that a multi-member LLC has that limited liability protection, right? Whereas a general partnership does not, unless they decide to either be a limited partnership or something of that sort, okay? And lastly, being that under any one of these entities, you are not an employee. You can only become an employee if you elect to be taxed as a different entity. And what that looks like is that could be either a S corporation or a C corporation. And that's pretty much letting the IRS know, right? But ultimately, under these circumstances, you should not be receiving compensation on payroll as an employee. That is critical to keep note of. All right. So that's pretty much it for this week. I will see you all next week as we talk about S Corps and C Corps. And that may be a little bit more daunting, but I'll ensure to break down as much as possible. Okay. That's it. And I will see you all. Have a good one.